Hello everybody and welcome to Confident Compounding with Corey Kramer. Today we're going to take a look at Legal & General Group PLC, ticker LGEN in Great Britain. This one came in by request down in the comments of one of my other videos a while back. I'm going to be working through my list back here on the chalkboard pretty quick coming up, so stay tuned for those requests. If you have a request, put it down in the comments. I'll get it on the chalkboard and eventually I'll make a video for you. Some of those I post here, some of those I post on the free tier over on Patreon, and I'm probably going to do about 50-50. Like I'm going to try to do about 5 a week here on the YouTube channel and another 5 over on the free tier on Patreon. And I also have weekly picks on Patreon for $25 a month. I posted a video on how those returns are doing here the first week of October, so check that out. Everybody really likes that service. And then I have a full service on Patreon as well. All those links are in the description, along with the link for 25% off Fast Graphs. If you've never used it before, just use the link in the code down there if you want to give Fast Graphs a try. They have free trials, which is what I'm going to mostly use for this analysis. So Legal General Group, I had never heard of it before. I just saw the ticker on my board from a month or two ago and took a look at it. So down here on the Fast Graph, we have life and health insurance. From in the UK, $13 billion market cap. So that would be kind of the, once I kind of glanced at it, that would be the next thing that I looked at. Also, it's worth noting, so if we just look at, sometimes I ask myself, well, why would a person ask me about this stock in particular? So it does trade at an 11 PE, which is relatively cheap on just the PE basis. But earnings have fluctuated quite a bit, probably due to fluctuation of insurance claims, I would assume. Over time, let's see how it's returned over time. I didn't check this yet, so we'll just take a look here over the past 20 years. If I can get the, oh, it's not gonna, let me refresh it real quick and see if I can, oh, there it goes. It's just running late. It looked like 7% long-term return if we go all the way back 20 years ago, 7% annual. What does jump out at me here is they did have a big decline during the Great Recession. So 80%, if you include the dividend, 75% decline. That's a very big decline. So we have, and then earnings growth without taking into account the fluctuations here. What are we looking at? 5%, which is quite low over time. And this will be, I don't know if it'll be in pounds or dollars. Might automatically switch it to dollars. Sometimes if I'm on a different exchange, it uses the local currency. So I'd have to double check what that is. But since, let's call it 2015, they actually have not returned much, probably just the dividend. So only 4% a year. That's about inflation during this period. 3.79% was the annual return. So really no returns in the stock over the past decade. And so I kind of look at it and I say, okay, well, why is this the case, rather than just jumping to, oh, it's cheap, right? Which is what a lot of people would tend to do. One thing to do is to look at the basic GAAP earnings instead. And now we get a different story here of the near term. So basic earnings without these adjustments, they've gotten crushed the last 1, 2, 3 years. I wouldn't totally believe these estimates here going forward. When I use the basic earnings, it always takes this very optimistic forward-looking projection. So really what we know is this past year was horrible. Not as bad as 2008, where they lost money, but not good, right? So if you have a business that really isn't growing and perhaps shrinking, having a 10, 11 PE, very reasonable. That's using the adjusted earnings still. So I don't see anything that makes this particularly appealing. You have, let's call it a no growth to slow growth business, especially since, I mean, if I would have started the graph here in 2006, only 3% growth. And that's what the stock has reflected with dividends the past 10 years. So I would call this a no growth business, generally speaking, with some danger that we see with earnings, GAAP earnings falling off a cliff. And these earnings did too, but the market never really totally bought into that. You can tell because the stock price didn't go anywhere. So there is you can kind of see how somebody would just look at the PE and think, oh, maybe that's, especially if you're looking at near-term earnings projections. Let's look here. So if they grow earnings 8% this year and they do 13 and 9, well, let's call that 10% earnings growth and a 10 PE. That does look reasonable, like a good deal. But I suspect that the reason I got the request was actually it does say British pounds here. I missed it. So not in dollar. It's probably worse in dollar terms. I can change it on the fast graph to dollars, but I haven't done that for a while, and I don't want to spend like 10 minutes trying to figure out how to do it. I think the real reason I got this question is because the dividend yield is currently 9% on here on fast graphs. That's this yellow line here. Now with a 9% dividend yield, if they can pay that dividend yield, and the currency doesn't lose too much, over the course of 8, 9, 10 years, you could earn your money back just from the dividend. So that does look tempting, right? Especially if you're kind of a dividend-oriented investor. I don't really care about dividends on themselves anyway. But the one thing I would note here is I wouldn't buy it for the dividend yield because it could get cut. They cut it by 50% back in 2008, which was the last time they had a decline similar in scale to what they're experiencing now. So we had a dividend yield of 6%. They got cut to 3%. Now, over time, they raised that, right? So pretty much the dividend is going to be the maximum return, I think, probably from the stock. I mean, I guess if you bought it during a big downturn, but the stock hasn't really fallen that much yet. Earnings look like they have. So it's just not my type of business. I want business. One of the main reasons to own stocks is you have a business that can grow earnings faster than inflation. These guys are basically at inflation if you're just on the pounds basis. I suspect they would look a lot worse if I did switch it to dollars. But I suppose that could reverse because the dollar is starting to get weaker. But all that aside, it's just not that attractive to me. So I was curious when I looked at the basic earnings, like what was the reason for this? And so I asked ChatGPT. And because I don't usually ask questions like this too much too, but without doing a bunch of deep research, it actually came back with some pretty good answers here. So we have investment and market interest rate value. So one of the issues, probably the biggest one, their asset management wasn't great either. So, but it seemed to me like the main thing was, and you're going to find this with a lot of insurance companies, if they're matching their duration of their investments with mostly long-term bonds, to like annuity or whatever kind of liabilities they have, life insurance or whatever. Long-term bonds have been a horrible investment in the past few years, and because inflation's going up and interest rates not kept pace. Well, they haven't fully kept pace. So in real terms, the investments that these guys are matching on bonds, long-term bonds, are not good. They're bad investments. And depending on how you ask in the structure of the rest of their business, people will say, well, they're required by law to match liabilities to their investment duration, right? Berkshire Hathaway doesn't do that, so it might be different in England and after Brexit, maybe in Great Britain. I don't know the specific legalities of it, but I do know that it's not a good investment. So if they're trying to make their profits, or they're required to hold bad investments, which in my opinion, long-term government bonds and probably a lot of corporate bonds are bad investments, because of inflation is unknown and almost likely to go up. If inflation does go down, it'll probably be because there's a horrible recession. And during the last recession, the stock lost, 75% or something, and the dividend got cut in half. So when you put all that together, it's hard to find like how they win, right? How they actually come out of this and with good returns. So I guess the one way they could do it is if they maintain the dividend, if the stock price doesn't fall too much, if it does what it's done the past 10 years. And, I mean, maybe if you bought, let's look at this here. I was trying to make the other case that I'm making sometimes if I can. Let's say you bought a dip right here, right? Didn't pay too much for it. They've been raising the dividend ever since then. You could have got a 9%, 9.25% return, total return with the dividend. And most of that would have been the dividend. So that's the type of thing that you would have to, maybe if you bought in 2022, it might have been similar. Like if you really bottom picked, you could have got a 15% return with a double, but that's still less than like what the wider market did. So it's like, do you really want to buy a mediocre business that has structural investment problems that's probably not mostly in their control at this point? They probably have an investor base that cares mostly about the dividend. So if they need to sacrifice long-term business quality to pay the dividend, they're going to do that probably as long as they can. So you could, if they can pay a 9% dividend yield for the next, I mean, if you buy it now and get a yield on cost at 9%, and they keep it for the next 10 years, you could do okay potentially. But it's also possible the stock price falls 50%. So you might not make any money anyway. And that's why these aren't like my favorite type of businesses to buy. So I would say not a horrible business. Maybe if a person's really locked in on the dividends, they could find a way, especially if if they do improve the business somehow. It doesn't even have to be by too much. If the earnings recover over the next 5 years and the stock price could rise 50% and then you're collecting 9%, like that's how you could win with this one, I think. That's how you could get a 15% return. It doesn't quite look like it's cheap enough yet for that type of thing, but I mean, crazier things happen, but it's not where I would be placing my bets, right? I would rather have a quality business that's growing faster, earnings faster than inflation at a reasonable price, than try to buy something cheap with a high dividend that doesn't probably have much growth in front of it at all, and may have problems if there's a high inflation environment. Okay, so those are my one more stock not to buy. I do have weekly picks, so for all the videos I say I'm not buying, I try to find something. I do find something every week to buy at least a little bit of. Check out that link over on Patreon. And if you found this useful, hit the like and subscribe button. If you have a request, let me know, and I'll see everybody later.